Morning, everybody. John Blank, Zacks Chief Equity Strategist. Today is Monday, October the 10th when I'm recording this. Let's go through disclosures. We do this all the time to begin, just to make sure these are just the views of me, John Blank. They are not necessarily the views of Zacks Investment Research, and past performance is no guarantee of future results. The rest of this you can read at your leisure. What we're talking about today is round 3 of our semiconductor discussion. Round 2 went real well. And round 1 was the big picture of the story of the broad, basis of how the industry works. Today, we're going to go through the top semiconductor ETFs. This is fascinating, how to actually make money picking an ETF on semiconductors. And we're going to talk about the auto semi chip story. There will be a 4th round, which will then get into electric vehicles. But we need to set up that for this discussion because the semiconductors are playing a role in the auto shortage. We'll get into a little of that in part 3. So to review today, let's go through a little bit of what we have learned in part 1 from last time in round 2, and then we'll skip into the ETFs. I'll spend most of my time here, and then we'll go into part 3 on the auto semi stocks. All right, part 1, materials from round 2. We've got 11 semiconductor industry groups to reaffirm and 12 Zacks price consensus and EPS surprise stock charts. These price consensus EPS surprise charts you'll be find on Zacks.com or Zacks Advisor Tools. All of this very helpful information, this background. At the end of the day, if we're going to talk about ETFs, we need to know the constituent elements of those ETFs. And this is basically why I'm going through this again. Number 1, we've got at least, I could say, 10 or 11 of these industries. They change a lot. But know the tickers and the general term for the industries and where we put them. This is just a very basic place to go look. For example, the general semiconductors, NVIDIA, Texas Instruments, and Intel. The analog and mixed radio frequencies, that's Qorvo and SWKS. Communications, ASMIY. Electronic components, NDEKY. Then in the middle, we've got analog and mixed, that's analog devices and MPWR. Memory, of course, Micron. Equipment Photomax, that's Fuji. Fab Circuit Foundries, I put it in green. This is very important because these are the people making these chips at the back end. Taiwan Semi, ticker TSM. At the bottom, digital and mixed, that's Avogo. Discretes, this company called Wolf. Probably don't know about them, but you should look into them. And the wafer fabricators, that's Lam, AMAT. And of course, the most important one of all here is ASML for wafer fabrication. Put these in green because they are those back-end critical players in this industry space. Now, we get into the top stocks. Again, we can go through, a lot of different names. These are the really big ones by market cap. I just want to point out, as a basis that, like everything else in tech stock land, that November period when the Fed started to drain liquidity hit pretty much consistently across any name. There was no difference here. Some sold off more than others. NVIDIA in particular was a massively shorted stock, but you can also see its earnings estimates collapsed here, unlike these other stocks. So the good news is that NVIDIA is cheaper, much, much cheaper. The bad news is its earnings estimates actually went down with it. What you're looking for when you buy these stocks is these nice patterns where there's no decreases in estimate revisions. For example, I would say analog devices here is probably the best looking of these, but look at AMD, really nice chart. For whatever reason, the market thinks AMD is very different and more like NVIDIA, but in fact, its estimate revisions look very good. But if I were to choose a start chart, this Avogo one and this ADI one look the best to me. And again, you can just see that all of these short patterns, big sawtooth patterns in all these charts. Just keep this in mind as our backdrop. It's been shorting down. We've got 3 different tests here. We got, 1 or 2 down here. Very hard to call a bottom. I wouldn't try, but they are cheaper. That's the basic point here. All right. These are yet more stocks. Here are actually the bigger shorted ones. Look at the Qorvo shorts, huge. Micron shorts, really big. The AMAT short, not as big. One thing I want to point out here with Taiwan Semi, ASML, and AMAT is in these share price charts, you are not back to these lows, whereas these other ones, Micron and Qorvo, you are. This is kind of the bad news here, because the really big names have not sold off as much as the lesser known names, or the more cyclical names in the case of Micron. This is concerning because it means these may have more downside to go to get to where these are. That's what I would interpret this meaning. So let's carry on. This is just backdrop. And again, looking for these estimate revisions that roll over like Qorvo, that's not a good enough story. But look at Taiwan Semi. That's a beautiful chart. This is a great buy right here in the 80s to 70s to Taiwan Semi. Keep that one on your radar. All right, to the semi chips. This is really the meat of my story. And the next slide I'm going to be spending a lot of time going back to. This is the one really critical, interesting investment component. These are the top 10 holdings for the top semiconductor ETFs. I've got 6 long ETFs, 1 3 times long ETF, and 3 short ETFs. So down here is the total return analysis, 1 year, 3 year, 5 year, and year to date. Now, what I want to point out here is SSG, USD, and SOXS. These are our short names. And SOXL is our long 3X name. So, for example, you can see very interestingly, if you shorted these stocks, it was good to play SSG this year or SOSX, but it was not good to play USD. Don't know why, but this is the cautionary tale of these inverse ETFs. You really have to know how they move to the market, and they can have very erratic patterns of behavior. It's very unusual. For example, just a 1 year return on these things can be anywhere from -4 to -50. Yes, they're all negative, but in very different directions. And then now we've got some that are bouncing and some that are not. I have no idea what to think about that. But here I would want to point out, if you're looking for the best 5-year name, interestingly enough, it will be this spider one, XXD, which has got 154% return over 5 years. Now you can do the math there. That's a 30% annualized return. XSD is where we want to think hardest about. It's a fascinating story. PSI and FTXL will be your typical Graham-Dodd, factor selection picks. And above them, we've got, the triple X one, you can see got hammered this year. So now its 5-year chart is very, very weak. Altogether, what I want to point also out is the sum of the total assets of these top 10 holdings can be very different. And this is very critical to understanding these returns. For example, SOXL, which is, the triple X one, you can see this is all this stuff up here is cash and other ways that they do this triple X. But 87% of this is in these top 10 holdings. Very, very concentrated. SMH, this one, you can see Taiwan Semi and Nvidia have these 10, quarter of the chart. And what's interesting about all these, when you get into these 60% of the top 10 stocks being 60%, that's typically the case here. It's typically the case here. Not so much the case with this factor one, but here, XXD, this is the one that works. And look, we got much weaker, slower amount of assets. It's a much more distributed, diverse semiconductor ETF, and that does drive returns. Interestingly enough, if you look at XSD's expense ratio, is actually not the highest. It's actually lower. However, there are ones that are even lower than that. SOXQ is the lowest. But what I will point out here, PSI and FTXL, why they have around 0.6, that PSI is trying to cut just to give you a little bit of a benefit. But these are the ones that they try those factor selections. They do the Graham-Dodd thing, and you can see you pay an extra 0.3 for that service. These ones are your inverse ones. You can see they're very expensive. That's 0.9 up here is your long one. Here's your shorts. But they'll charge you 1% of assets, these inverse ones or these 3X ones. So this is the much more intensive process of running these, and it's much more expensive. I don't know if we can see that it works. These are very cautionary tales. They're not only expensive, but their returns are all over the place. So if you look at all of this, again, XXD is by and large a 30% hold annually, and it's a low expense ratio stock. And the bulk of it is because it has much more diverse small and large cap and mid cap chip holdings and no more than 5% of assets on any name. You just see the names here. For example, there's Wolf. There's that discrete stock you've never heard of. We've got On in here. We got, Rambus, AMD. A lot of the smaller names are in this thing. So if you're looking for beta, share beta and diversification across a lot of chips in a good story long term, XSD is where you're going to want to go. So I'm going to go through the different holdings just to show you just really quickly how people build these ETFs. Number one, the VanEck ETF, that's SMH. This uses the Market Vectors US listed Semiconductor 25. Market Vectors says 25 of these stocks, and they are, it's a modified market cap weighted. I put that in blue. This is also critical. This is going to give you a lot of the market cap weighted, so you've got the bigger ones in there. You have to generate at least half your revenue from semiconductor equipment for being the VanEck SMH. Direction Daily, Semiconductor Bull. This one uses the ICE semiconductor. We'll see this again used again. This is now 30 large companies, but it also includes those that do LED and OLED technology. So it's a little more diverse background with some of the equipment that is used, and is trying for that 300% story. So this is the big, super leveraged play, ticker SOXL. Here it is. This is the one that was best. This is the SPDR Semiconductor ETF, XSD. And you can see that the total market index tracks all the U.S. common stocks on the New York Stock Exchange, the Amex, the NASDAQ, and the small cap exchanges. The semiconductor is a modified equal weight index. There is the key difference. The play that works here is keeping modified equal weights across all common stocks that are semiconductors. So this is a much more diverse and also smaller portfolio weights index. That's why it is different. That is why it outperformed. Interestingly, who would have guessed that was the key criteria in advance of this discussion? Keep this in mind. Ticker number 3, XSD. Invesco PSI. This is going to do all the typical Graham Dodd stuff. Growth, valuation, timeliness, risk, dynamics, semiconductor Intellidex index. It didn't play out to work very well for you. It's costly, and it didn't actually offer bigger returns. PSI sounds great, but it didn't work, at least in hindsight. The same is true for First Trust, FTXL. This was a modified factor weight index. That's kind of saying the same thing. They're trying to use factors to weight these things and pick better stocks. It didn't actually work out better. Down here in the Invesco Philadelphia Semiconductor ETF, SOXQ. You may not know this, but there's a Philly Semiconductor Index that trades in the Philadelphia Stock Exchange. It began in 1993. It split in 1995, and options began back then too. But this is involved in design, distribution, manufacturing, sales. So it's a different type of index. There are 30 in it, and that's the SOXQ because it's using the Philadelphia Semiconductor Index as its base. Number 7, this is the iShares SOXX. It's like you saw before with the leverage ETF. This is used in these ICE 30s. Again, this I thought in advance, we think of iShares as really kind of a great idea, but it's actually diversified outside into these LED, OLED, that's the TVs. And you've got 30 of them, and it is looking at something that has very different portfolio weights, much higher portfolio weights. All right, so let's get into some of the fund flow charts of these things. I just want to point out that, we've seen a lot more volatile fund flows across some of these entities in the last few years, up and down, by the way. The difference one here is SOXX. If you remember what that is the iShares one. iShares has been bought much more consistently. PSI, SOXS, all bought a little bit more than these others, but for whatever reason, people have not been buying the XSD in the manner that you would have expected. Not sure why, but again, this points out why the value of these types of discussion, because XSD really is the one you wanted to buy. Everybody was buying SOXX. Value marketing here, folks. Pay attention to this type of thing. Price to earnings and price to book. This is fascinating. We know they rolled over from highs in the 35 on the price to earnings. Now they're down in the 15s. This is true across the markets. You can see that again. Let's use XXD. It had a lower price earnings ratio to start with and came down less. So that diversification really worked for you. You get much higher PEs when you're more concentrated, and the sell-off got you the same place anyways. Interestingly enough, PSI from the price to book value predicted stayed up higher longer, and then it came down harder. So for whatever reason, you got a little bit different story because I think they're using quantitative fundamentals. PSI, that factor weighting is going to give you a different look when you do price to book versus price to earnings. Fascinating to look at price. That is what you get out of their selection criteria. But again, if you just wanted to stay with the lower volatility one, that is clearly XSD once again, because they've done their portfolio weightings much more diversified across all kinds of stocks. Total returns. Well, obviously, this is back from 2016 over the last, 6 or so years. SOXL, this is your triple X. You can see if you got out at the highs, you had an incredibly good trade. It does go down in these recessionary periods. It's already sold off as far as this market's concerned. And now, even if you got out of SOX now, you would still be doing better than anything, including USD. USD, like I said, is that SPDR one that's been my benchmark. You can see that SPDR basically bought you 10% over the last 6 years over these interests. 5% a year, folks. It's not a small number from a returns perspective. But again, could you use SOXL? Clearly, in a bull market, it worked for you. I don't know we're at anywhere near a bull market for this now. I would be a little reluctant to use it because you might just get driven down harder, faster in that thing right now. Very interesting. They're all the same, basically. You can see nothing's really giving you a real different look other than USD, once again, is giving you a much more stable pattern. Keep that in mind. All right, this is the 3-month excess price change. This is just giving the volatility of these. Got to keep in mind some of these things are used for trading purposes. SOXL is a classic example. You can see it's really spins up and down much more than these other ones. That's what I basically want to point out here. When you buy these inverse ETFs or leverage ETFs, you're getting a much more broad volatile stock pattern. You're trading off some of the volatility you get away from a good portfolio weighting, and you're putting it back into the inverse. So you got to put up a lot more volatility when you use these inverse ETFs. Okay, so I'm going to go through one last thing today. That's the auto industries and the semiconductor story here. This will be mainly setting up for the next slides that we're going to do in a couple of weeks' time. But it is fascinating stuff, and it does relate to a lot of these companies. For example, here we have over here, this is light vehicle sales for autos and light trucks. This is your typical story. There's your 17 million units before this thing of COVID hit. We got all the way back there, by the way, at the first run. There was actually excess selling. There was problems, and then we brought it down to the 13s when this semiconductor shortage hit. This is the semiconductor shortage right here, along with all the other parts. That's where the inflation hit. There was actually, you probably have forgotten, here we're actually trying to sell these things off of lots. Interestingly enough, the heavy trucks have come back the most here. They're working in an environment with lower units, and they're getting less demand constraints out of the heavy trucks, so they're moving up quicker. You can see here they've really made some progress on heavy trucks, getting the unit sales up. Here with the light vehicles, they really have not. And here, over here, you can see what it did to prices. I've said this to board of people. We've got to clear this inventory story up before the price story changes. This is Exhibit A. For example, you have the new vehicle prices here and the used vehicle prices. So as soon as this whole shortage hit, the used vehicle market took off. You got to remember this. We hear too much about prices and not enough about quantities and inventories until we get back to 17 million units on light vehicles. forget about getting these used vehicle prices down in a meaningful long-term way. We have to do this. Now, this is the stocks that we found are in the automotive semiconductor market. You can go back and bookmark this. A lot of the names you may or may not know, they're the names we've already discussed. Some of them are new. Renaissance, Robert Bosch, and Rome are new to this discussion, and they're basically not American companies. Keep that in mind. There's a lot of work in automotive work, particularly in Germany with Audi. Audi is going to come up with a level 3 here in the fall. In Europe, level 3 automation. First time ever it's going to be sold. It will be sold in the United States without level 3, but it will be sold in Germany with level 3. We'll get into a little bit of that, but these are the names that are playing a role over in Germany. All right, so this is interesting stuff. This is revenue growth. And you can see for yourselves, typically the names of the companies that we're talking about here and the growth rates of what has happened in 2021 as they rebounded off those COVID suppression highs. So once again, a lot of these huge numbers here have to be factored in from the shutdown numbers. I would take these numbers together in aggregate and, average them out to say what's really happening here. Because oftentimes, for example, you get lower numbers here, you get high numbers there. But for example, over here in Micron, I think this is fascinating. You do see the China slowdown is still hitting in 2022. They've given us the 2022 numbers. This is probably the most interesting spot to look at right here. And you can see China is still quite slow, whereas Taiwan is quite high because they're making so much chip-related stuff. But again, you're looking at all kinds of numbers for the United States, 17, 20, 30% growth. It's no surprise with the ETFs. These are the kinds of returns you can get because the growth rates underneath these stocks is that much stronger. So that's the point here. Why would you want to buy these long-term and put them away as you're getting your double-digit returns and revenue growth from these for the foreseeable future? That's a great number for an investor. Advanced driver assist systems. This is some language I want everybody to spend some time on. The main point I want to point out is we're already in advanced driver assist systems. This is level 1 and 2 in your typical cars. This is traffic sign recognition, blind spot detection, emergency braking automatically, pedestrian detection, and lane departure warnings. This is the essential safety critical stuff. Here's the other things it does for you. And down here you can see that I have my discussion of the levels from 0 at no automation to 1 at driver assistance to 2 at partial automation. 3, 4, and 5 is when you get into actual, unused, without a driver kind of thing, from conditional to high to full. This is where we're headed. This is the Audi. We'll get to 3 in the fall in Germany, but nowhere else. These are always on the road right now. This is basically where the Teslas are at now, is level 2. Okay, so here's the discussion, more detail. This is best to get in terms of your Zacks professional services slides to read this. The main point I want to point out here is the AA story of level 3. This is critical for understanding what's going on. They're going to ship these because they didn't get compliance with US regulations, but the Audi A8 is going to be the first level 3 car out there, and it's going to be sold in Germany. Level 5 and level 4, this is interesting stuff. Names like Waymo and Navwa, Magna, Volvo, Baidu. This is where the players are looking for taxis. Taxis are going to be the big issue over there for level 4 to start. Okay, thanks for attending today. I hope you enjoyed it. We'll do another one discussion down the road in a couple of weeks on all of the electric vehicles and chips. I hope this is a great background for that. If you want to contact us, go ahead and use 866-794-6065. Strategy call at zackspro.com or on the web, www.zackspro.com. We also have a Twitter feed at ZA Tools and a LinkedIn at Zacks Professional Services. Get these slides from us. This is really the detail of our business. We work hard at bringing metrics and quantitative factors to your discussions so you can make higher returns. This is exactly the kind of story you can have today. Finding ETFs and the stories behind them and why they're doing better. This is professional services personified, and I hope you liked it.